You've been told you got to risk big to win big. But what if that's the very thing keeping you broke? Because wealthy investors know better, and I'll show you how they really build freedom, and you can too. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you. You want to become work optional. You want to have enough passive income coming in that you can work because you want to, not because you have to. That you actually have control of your time, your freedom, and have that not just money freedom, but time freedom as well with the family, being with those you love, doing what you love. But it's not just letting you live a rich, and fat and happy, but it's living a rich life because as you're blessed financially, as you have more resources and means, you can bless more lives. And that is what it means to be a Rippler. And that's what I'm so proud to be able to do with you guys today. Thank you for so much for joining us in this movement. Again, my Ripple Effect is here to create at least 1,000 families financially independent by the year 2030. And you could be one of those as well. Reach out to us at moneyripples.com or even try our passive income calculator to see if that can be possible for you. Go try that out today. All right, guys, let's talk about this high risk, high returns, right? How many times have we heard this over and over and over and over again? Yet what I find it's the opposite when there's wealthy people involved. Wealthy people do not like to take big, huge gambles, right? Many people say big risk creates big returns, often are gamblers, not investors. Investors think differently about risk. And I want to really define and differentiate that for you today because I'll tell you, the people that believe high risk creates high returns are the ones that usually never get the high returns. Now, again, as a financial advisor, I used to teach this all the time. I believed it to be true. But I want to get down to the core of this. For example, risk. And you've heard me say this on even recent episodes. What is the definition of risk? As a financial advisor, we were literally tested on this. The definition of a risk is chance of loss. So this is what woke up to me, right? Right about the time that I started to leave being a financial advisor and went into this whole new alternative investment space, right? And sort of learned that there's so many other things I could do and create greater wealth with less risk. One of the things that I kept hearing was like, okay, well, high risk creates high returns. Well, if risk is chance of loss. How would a 90% chance of losing create a 90% chance of winning? The math is mathing, right? Like it's got to be, if there's a 90% chance of loss, you only have a 10% chance of winning. Now, some people say, well, no, it's because the wins are bigger. And so you just got to figure out how to spread your losses. And understand, I was a stock trader, right? I taught people how to do this stuff. I taught people how they could actually lose more times than they won and still make money trading stocks and options. But they had to be very disciplined and having like stop losses and things in place so that they could still come out ahead at the end of the day. But again, stop loss is a risk, is a way to lessen risk to be able to help them do that. But the riskiest things you could possibly do is like, hey, I'm going all in. The biggest chance of loss is buying a lottery ticket. Let's get the freaking Powerball or Megabucks tickets, buy that to cash out everything you possibly own to buy as many tickets as possible to see if you actually win the lottery. Big returns, big risk, yet in most people's cases, massively big losses. And that's how people become broke. That's why people are stuck. Where did this even come from in the first place? Now, this is something that I had to really consider, but it wasn't hard to figure out because most of the things that we're talking about with all these money myths and everything else, most of this came from the financial training that I received. Well, who did I get it from? I got it from other financial advisors. Well, who did they get it from? They got it from financial companies. Well, why are financial companies teaching this? And do they perform the same way? Because if this is true, shouldn't the largest companies, the biggest banks, shouldn't they be taking the biggest risk possible? I mean, hey, remember good old AIG, right? How did they do? How did that work out for them? They were a big company that took big risks. Fannie Mae, Freddie Mac had to be bailed out. The big five banks had to be bailed out during the global financial crisis because they took too big of risks. I mean, Fannie Mae and Freddie Mac, they were able to loan out 100 times what they had in cash reserves. The big five banks were able to loan out 40 times. 40 times. That means if you put $100,000 in their savings account, that gave them the permission to loan $4 million, right? Think about this. Big, big gamble. And what ended up happening? We had to bail them out with our government dollars because they were, quote unquote, too big to fail. Now, they took those high risks. Now, did every bank do that? No, definitely not. But obviously, the ones that were newsworthy, we heard about, didn't we? But the vast majority of banks didn't take that kind of big risk, subprime lending and stuff. They learned their they learned from that. Some of them did get greedy. They lost sight of this and took big risks, and they had big losses. Unfortunately, you you don't have the government to say you're too big to fail. You're not the kind of person that the government says, you know what, we need to step in and help these guys out because if they fail, all Americans fail. That's not going to happen in your own personal life. The banks, they knew they could probably get away with that because they've got lots and lots of money involved there. Not to mention the CEOs that took nice big bonuses after they got those bailout checks. That's another issue too. Again, I'm a big fan of good capitalism. I'm not a big fan of like greed and being idiots. Okay. So, anyways, the BS about the high risk, this is where it comes in because in most cases, like financial institutions, for example, you don't see financial institutions taking big risks because when they taught me to teach you as a client, they said, hey, it takes big risks to make big returns. You gotta, it depends on your risk, risk tolerance is what they refer to. And so I give you a questionnaire and you take out, answer all these questions of how much risk tolerance you have, and then we put you in the appropriate fund. But all the time, I remember there was trainers and everybody else would say, hey, listen, you're young, take all the risk you want. Lately, especially because the market's been up so many years in the last 16 years now, and only one down year, there's idiot financial advisors, even experts in the media and everything else, so-called experts, saying, hey, you should go more aggressive, right? You should go more, put more in the markets. You should take higher risks right now so that you get the big enough return so that you can have a great retirement and all that kind of stuff, right? But those companies aren't taking big risks. What I taught people was that banks and financial institutions were the number one investors in the stock market. I was wrong. I was absolutely wrong. Now, are they the biggest investors? Yes. Is it their money? No. This is the big difference. You got the guys at Goldman Sachs and everything. Yeah, they're putting lots of money in the market, but are they putting their own money in? No, they're not. They're putting your money in there. That's why they're big investors. They're pulling all your guys' money, throwing it in to buy the stocks and everything else, and hoping and praying it's going to work out. Because many times they don't know jack squat what's going to happen in the future because nobody knows. So that's what they're doing. They're putting their money in, right? You've got like ARK Investments. We got, Kathy, I just blanked on her last name, but she's put tons of money. She was taking big risks, big gambles as a money manager and lost tons of money the last few years. And people are still thinking she's a genius, right? People are like, oh, she's ahead of the curve. She's pro, she's pro Bitcoin and digital assets and stuff. Well, that's great. But guess what? She still lost a lot of her clients' money in the last few years and they haven't even recovered it yet, right? Even though the market's gone up, hers have not. So there's always these things that people think, oh, it's great. But again, she's not sacrificing her own money, right? She's using the clients' money. It's your money that's being gambled with. What's the money they're taking? Where are they making their money? Not in the markets. They're making their money off of the fees they charge you. Think about that. All these companies, these financial companies, they're charging you fees. They're also using those fees to pay financial advisors, right? But they're making guaranteed fees. You never hear a financial company saying, listen, if you lose money in the market, I'll make sure I lose money too, right? They don't lose money. They just lower the amount of money they're going to make off the fees, but they're always making money even when you're not. That's why I always say it's kind of criminal what they're doing. It's ridiculous. But the biggest thing is this, is that they're making the guaranteed fees. They're taking low risk to get higher returns. That's why, again, I always tell people, and even the people I trained to do stock trading and options trading, there was 200 clients over several years that I had coached. And if I were to really look back, those people that after I was done holding their hand and I wasn't keeping them accountable and they're left to their own devices, even though they had all the right tools, all the right training and ways to do this, still, I would say a handful were still making more money after we were done coaching than otherwise. Does that mean I was a bad coach? No. It just means that these people obviously didn't want to obey the rules. And even then, it was still a big gamble. If people believe high risk creates high returns, they're a gambler. And by the way, I actually used to tell people that. I used to teach my own clients saying, listen, if you believe high risk creates high returns, you are wrong. You have to find ways to minimize those risks, minimize those losses, right? How do you do that with investing? How do you do that in the real world? What if you're not going to be a stock trader, right? What are we talking about here? Now, with mutual funds, people say you just diversify. But the truth is, you're never diversified in the S&P 500. You're in the same asset class, right? You're throwing your money in the same place. The market goes down, everything pretty much goes down. Everybody, it's like I love what Robert Kiyosaki, author of Rich Dad Poor Dad, would say. He's like, diversification based on what financial advisors tell you is like buying 5 used cars in case one of them's a lemon. So you're like, hey, in case there's one bad car, I'm just going to buy 5 used cars. No, buy the good car. Find the one that's verified, clean title. Maybe it's newer, maybe it's got less miles. Buy that. It might be a premium cost, but it'll be less risk and you'll waste less money, right? That's the reality. That's the real life situation. Remember, if high risk creates high returns, if that were a true principle, should we be taking high risks with everything? Should we take high risks in our marriage? How's that going to work out? What if we have a higher chance of losing in our marriage? And I don't mean going all in. That I believe is actually less risk, right? I'm talking about what if you start doing things that are actually bad for your marriage? What if you start abusing your spouse? What if you start like cheating on them or whatever you start doing? That's going to destroy your marriage. Take high risks with your health. Why don't you go eat at McDonald's every day? See how that works, Mr. Supersize Me? Doesn't work, right? You have the only thing you get a higher return on is your fat and cholesterol, but you're dying, right? You're actually killing yourself in that process. So why would high risk in all those other areas not create other issues with money? It is, but we've been brainwashed again because it's been taught and permeated in our culture that that's just got to be truth. We just believe it without even questioning it. Question it, for crying out loud. Question it and see what you really think, because it's just not true. And so instead, what do I do? Like, how did I do that with real estate? Well, real estate, one, we already addressed this before. Real estate historically doesn't go down as much. It actually does a pretty good job, right? That helps for number one. But what about like other things? Like, what if I'm investing with somebody else? How do I minimize risk? How about understanding who the investor is? That's why I'll question the investor. Like, I'll question them about their philosophy. If they believe high risk creates high returns, I don't invest with them. That's a horrible thing to do. That's bad because they're going to gamble your money away, especially if it's not their money. Oh, key point. I also, if I'm going to invest with them, I want to know that they're putting their own money in those kind of things too, right? So if I'm putting my money in something like that. Now, I had somebody reach out to me and they said, hey, Chris, like, will you partner on every deal with me? So we go in all the same deals? I'm like, no, because the deals you're going to pick are going to be different than the ones I want to pick. I got plenty of opportunities. I got plenty of things to do. I don't need your money to go in with mine. I've got stuff I'm already doing. But yes, with our clients, are they using some of the same investments many that I've invested in or other people that we have invested in? Yes, of course. If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now. But again, I look for how to minimize risk. So I don't just look at the deal. Of course, looking at the deal makes sense. How do I make sure that's going to make money? What happens if there is some kind of down market? What happens if there's stress happening? Where's my recourse, right? For example, if I'm lending my money to a real estate investor, I can just throw my money at them if maybe they promise me big returns. By the way, the first question I ask myself that I use to really ensure that I'm not taking high risks is I'll ask, other than the rate of return, why would I do this investment? I question my own motives first, because the thing is, when the greed bug hits you, which is a scarcity emotion, it can hurt you, right? I've seen too many people chasing high returns and then they lose money, especially when they still deep down still believe that high risk creates high returns. If you still have that, root it out, get rid of it. Lower risk creates high returns. If I have a 5 or 10% chance of losing, I've got a much bigger chance of winning and creating a lot more wealth. That's what the wealthy does. That's why even hedge fund managers try to find ways to do their due diligence, make sure they're not just throwing their clients' money away, that they can keep building and growing their wealth. They're trying to preserve it, but they're also trying to grow it too. You should be doing the same thing. It's much easier to preserve your wealth, to have a return of your money, than just getting a return on your money. So I question myself and my motives first. Then secondly, I question them. Who are they? How experienced are they? How long have they been doing this? Are they been doing this kind of strategy over and over? How many hundreds of times have they done this? Thousands of times even, right? What have they done? So when I'm looking at lending my money to somebody, I want to know what their experience is. I want to know when they had bad deals, what happened? What did they do? Did they try to find a way to honor it? And even though they knew that might be coming out of their own pocket, I'm not saying they have to do that, but did they try to find any way possible to make it right? I have a friend that actually does short-term lending with some of our clients. That one of the things that impresses me about him is that he bailed out a deal that he didn't have to bail out. He actually bought a deal, a bad one, from a partners just because he had a few of his own friends go in that deal. He literally paid $2 million to bail out the investment of his own cash, 2 million of his own cash to bail it out, so then he could take it over from those other partners who were driving it to the ground, so that he could try to turn it around. Guys, that says something about character. Character is hard to find, but you only get that when you know somebody's had a lot of experience and they've been doing the same thing for a long time. And again, character is one of those things that's just a part of who they are. So again, does it make it risk free? No, but that helps. Also, if I'm lending my money, what's the loan to value? For example, what's the verified actual value of that property after it's been renovated? If it's a fix and flip type of situation, well, I want to make sure there's at least 35% equity in that property. Sometimes I get nervous when people say, oh, they got 20% equity. I'm like, yeah, but that's some wiggle room, but that's not a lot. Like a bank, and the bank does this to you too. By the way, banks are really good at not being risky. This is why they check your credit, they check your payment history, they check like anything in your history for that matter. If you have bankruptcies or anything like that, they want to know about it. They also want to verify your income to make sure you have enough income to help pay for those payments long term. How long you've been working in your job, so the job history and things like that. And of course, they want to know how much equity, if you're buying a house, how much equity is in that property? How much of a down payment are you putting in of your own money? Because they know when you put your own skin in the game, you're going to be much more committed. And if there's equity in there, they know worst case scenario, if you stop paying them, they can then take the property back and sell it and get their money back and maybe more. I do the same thing as a lender, right? I'm like, if I have that deal, if I have at least 35% equity in that deal, great. Because even if something happens and they are not paying me, I can then claim that property if the paperwork's done correctly. That's another thing too. You got to make sure you're doing the right deal and you're doing it, it's being done correctly. But if I'm in that first position where I'm the first one that gets paid back, right? Just like a mortgage, just like a bank does, that could be my property. So there's a lot of things you do to reduce the risk. How about buying a rental? Again, I started buying turnkey rentals because I knew me as a property manager sucks. I'm not very good. So what I do, I went and I got somebody who was a good property manager. That's the biggest risk, in my opinion, of a turnkey rental is who's going to manage the property. That's a big, big deal. Now, they hopefully are also doing their own kind of due diligence. If they're a good property manager, they're also getting the right renters in your home, right? So you make sure you get the right quality people in there. Now, what are other things they do to reduce risk? Well, when I'm buying this property, even before I get the property management in place, buying the property, one, I want to make sure the appraisal is good. So when they go in, the appraiser goes in to verify the value. I had this situation happen with my very first turnkey. The value, the offer I made was a little bit higher than the appraisal. Now they could have forced my hand and say, hey, we'll put more money down so then there's enough value to then do the mortgage. But I said, nope, I want to lower that price. And so I had them lower the price by $2,000. It wasn't much off. I said, lower it $2,000 and you got a deal. They did. They lowered it down below what the appraisal was and it was done like that. Also, when you have like the home inspection report, right? A home inspector going through, now you could just trust the home inspection report. There could be some risk there. What if you're the one that's walking through too? By the way, doing a walkthrough of that property, even though it might be in another part of the country, may not be a bad idea to be able to see and verify, hey, is this good? Or have somebody do a video walkthrough and even say like, hey, slow down. I want to see the corners. I want to see everything, right? Like walk through this property slowly with me so we can see what's there. Same thing with the home inspector, right? Because home inspectors may or may not always catch things. And so, make sure you verify that there's not like major repairs that need to be done. Like all of a sudden, like you find out that the foundation is cracked or something like that. You may not want to buy the property. You can bail out and back out of it. That's why I tell a lot of my clients, they're like, yeah, I don't want to buy a bad property. Well, that's where the due diligence comes in, right? Like it's not that it's active, but there's a few little things you got to do, little benchmarks that you got to do along the way. Syndication, same kind of thing. That pro forma, is that really good? Is it based only on appreciation or is it based on the current rents right now? Like this thing's already rented, it's already working. I know that this is going to make this much cash flow. So even if we have to hold it long term, regardless of the values, it's still making money, right? Those kind of things. So all those kind of questions and things that you try to ask to, again, minimize your risk. And that's what I love is that the best investments are the ones you can control the risks. You can do different things and have different factors in place, to ensure that you have a little bit more security. Never is it going to be risk-free. Never is it going to be 0% risk, but much, much better. By the way, even on the business end of things, when you're looking at a business, right? Verifying the P&Ls, the profit and loss and things like that, verifying like what happens in different scenarios, right? Who's in charge? Who's the leadership team? Assuming it's not your own business. Now, if it's your own business, you've got the controls, you might be able to create less risk. By the way, think about this. If you were a business owner, why are you investing in the stock market in everybody else's company more than you might be in your own? Does that really make sense? You put your money in something you have no control over, like Tim Cook with Apple or something like that, or Elon Musk, in which Elon's not always consistent either. You put money with them when you can be putting money in your own business and make more money. Now, I know a lot of business owners, especially the successful ones, they get this. They're like, that's a no-brainer. I get it. Now, of course, do we only want to have money in business? No, of course not, right? We want to be able to have our money in other places to generate multiple streams of passive income, especially outside of our active income. But I mean, a good example, right? Like many of us as business owners, we don't just go and gamble and just try to say, well, I'll throw money at it. I might lose everything, but oh well. No, we don't do that. We do something that we know is going to work. Even Walt Disney, when he was wanting to do Disneyland, he was having to put up a lot of money. He sold off his investment property. He went and, of course, he used his life insurance and leveraged the cash value of the life insurance to use as extra collateral to get ABC to come in with the rest of the money. But man, he was committed. He put time and energy into it. And that's one thing that many people, I think, miss is that sometimes we think we just throw money at stuff and that's it. But in some cases, can you apply your own time and energy to ensure that investment? This may not be the case with some of these passive investments we talk about because we talk about passive investments. But I have seen many cases where I even saw one guy where he was going into an oil and gas investment with a small oil operator. And he realized, he's like, the people that are the partners in charge here, I can see that there's a weakness with them. Like they're not communicating well. The operators have their own language. The CPAs that were partners have another language. He's like, what if I'm the CEO? What if I kind of bridge the gap between these guys and help them with the communication and pull these guys together? He's like, because I've got money invested, I don't want anything to go wrong. So he actually kind of self-appointed himself as a CEO. Again, it was a small group. Made himself the CEO, even gave himself $1,000 a month salary for being a part-time CEO with them. And he was ensuring his investment, making sure that, of course, that things are running smoothly so that he wouldn't lose his money in that oil deal. So think about it. There's so many creative ways you can do that sort of thing. Many cases, like when I'm looking at different types of when people come with me with business deals, I have to ask myself, do I have enough passion to even care? Do I want to be involved and to what extent? And if I am not going to be involved at all, this thing better be humming and singing without me there. Otherwise, if it's something that does align with my passions and maybe I'm really like it, maybe I want to put my own time and energy to ensure my investment. Warren Buffett does the same thing. He brings his team in to his companies when he has a good, massive share in that company. He wants to make sure that everything's going well. He wants to make sure that things are running smoothly. He'll have his team involved so that he ensures his own investment. That's what a real investor does. That's what wealthy people do. That's what they do with risk. They lower risk, they minimize risk, and control as much as they can, while gamblers still believe high risk creates high returns. So I know I went longer on this risk thing longer than I expected, but I wanted to really dive deep into this instead of just giving you some kind of platitude or lip service. Is that the truth is that it's not high risk creates high returns. Lowering your risk, controlling your risk can create massively higher returns than gambling your money, hoping to make it big. That's what gamblers and broke people do. They gamble, they throw money at things, hoping it's going to work out. But the truth is, they are always easy come, easy go when it comes to their money. A real wealthy person, a real investor says, how can I control my risk so that my wealth will ensure to keep growing year after year, day after day, to the point where I can create massive generational wealth that goes way above and beyond me. That's what real wealthy and real investors do. That's what I challenge you to do as well. Forget the whole stupid high risk creates high returns. That's what a financial advisor, that's what financial companies want you to do. So you take all the risks while they take none of it. You deserve better than that. You need to make sure you're taking lower risks to get better returns. And you can do that, especially when you start going outside of Wall Street, when you start to go into the main street of investing and finding ways to even minimize your risk so that you can ensure that you not just get a return on your money, but you get a return of your money back. That's what's important to wealthy people and investors, real investors, and it should be for you too. So I challenge you, go and become a real investor so that you can become wealthy as well. Make it a wonderful and prosperous week.